Silicon Valley Bank customers at the center of one of the biggest runs on deposits in history.
Quite nerve-wracking.
Met with reassuring words from federal regulators who've taken it over.
So you will be able to transact business as usual. Your accounts are safe. Your online portals are active. You'll be able to wire and do business as usual.
The US government is giving the same protection to customers of the New York-based Signature Bank.
This is something I did not expect.
Both collapsed in recent days after customers worried about the bank's solvency began withdrawing their money by the billions until the government stepped in to guarantee their deposits.
The banking system is safe.
President Biden trying to soothe financial markets after bank stocks plummeted amid fears SVB and Signature would create a domino effect. The US central bank, the Federal Reserve, is also trying to calm the storm by setting up an emergency lending fund for any banks suffering liquidity problems, effectively backstopping the entire financial sector with its huge reserves.
The Fed learned the lessons of the 2008 global financial disaster when it had to step in to save the entire banking sector with no real playbook. So this time it acted decisively to stop contagion spreading too fast and too quickly. But the collapse of these two banks now presents the Fed with a fresh headache over how to tackle the highest inflation for years.
SVB collapsed partly because it made huge investments in long-term bonds and treasuries that typically rise in value when interest rates are low, as they had been for the best part of 15 years. But when inflation spiraled out of control, the Fed began raising that benchmark interest rate that in turn influences the rate banks and other lenders offer.
The value of those long-term bonds and treasuries dropped as interest rates rose. And quickly SVB found it was suffering huge losses and then trying to cover those customer deposits. So this crisis stems in part from the Fed aggressively raising that benchmark interest rate over the past year or so to try to drive down inflation, leaving some banks brutally exposed.
Just last week, Fed Chair Jerome Powell told lawmakers he planned to keep raising those rates.
The ultimate level of interest rates is likely to be higher than previously anticipated,
especially as the latest data out this Tuesday shows annual inflation at 6%. That's 3 times higher than the Fed's target of around 2%. So many experts now say the SVB and Signature collapse means the Fed will halt that interest rate trajectory at its next meeting, even as inflation remains stubbornly high. Owen, Fairclough, CGTN, Washington.